everyone, welcome back to my YouTube channel. In my previous video, we learned about liquidity sweeps and stop hands. Now today we are going to one step deeper into smart money concept. Today's topic is internal liquidity versus external liquidity. So before I start my video, I want to tell you one thing. If you haven't watched my previous videos like what is liquidity, what is loss, what is chalk, what is market structure, you must watch and then only come and watch this topic, because according to me, you can't understand this topic if you don't know what is market structure and what is loss, what is chalk. So make sure that you covered those all topics and then come to this topic. If you understand this concept properly, you will start understanding where market actually wants to move. So in this video, we will learn about what is internal liquidity, what is external liquidity, difference between both internal and external liquidity, and why market targets external liquidity, and how smart money moves price with real chart logic. I will explain these all things in this video. So now understand this carefully. Market does not move randomly, right? So most of the time market moves from one liquidity area to another liquidity area. So now liquidity mainly divided into two parts. Simple, one is internal liquidity and another one is external liquidity. Now let's understand internal liquidity first. Internal liquidity means liquidity that exists inside the current structure or current range. So for example, small equal highs, small equal lows, minor highs or lows inside the trade. So these are internal liquidity areas. These areas usually created during pullbacks, consolidations and retracements. Now let's understand what is internal liquidity visually on real chart. Okay. So here you see market. This is gold chart in 50 minutes time frame. Here we find uptrend market structure, bullish market structure, like pullback, again chalk, boss. On retracement, boss, on retracement, boss. So higher high, higher low, higher high, higher low. You see this thing. So here, as I mentioned, we see internal liquidity while taking pullbacks, consolidations and retracements. So here we find retracement, right? This is retracement, this is retracement. Let's see this watch deeply in 1 minute time frame. Then you will understand very well. I'll show it. Yeah, here is this. So market in higher time frame, it's making higher high, higher low, uptrend. But while taking a retracement, it's making like downtrend. See, you can see lower high, lower low, lower high, lower low, lower high. Let me change the color, you will understand very well. So this, while taking this retracement, market made another trend like downtrend. So these small lows become the internal liquidity, internal sell side liquidity, because we are in upside market structure. So while taking a retracement in upside market structure, we will find sell side liquidity, sell side internal liquidity. Why? Because traders place stop losses below those equal lows, or breakout sell orders below those lows, right? So see, here you see equal lows. This is one low and this is one low. Usually we will find liquidity at lows. So here you find sell side liquidity. Sellers often sell from here and you find stop loss. So this is sell side liquidity. And buyers here, they often make a buy entry here. And what happened? First their stop loss get hit, like while making this swing. Let me remove it. When this wick comes downside, buyer's stop loss also gets hit. Since these liquidity areas are inside current bullish market structure, so they are called internal liquidity. Now let's understand what is external liquidity. Let me zoom out this chart. External liquidity simply means major liquidity resting outside the current structure range. Okay, usually external liquidity is found at major swing highs, major swing lows, previous day high, previous day low, weekly highs and weekly lows. Okay, these are called strong equal highs or strong equal lows. Now the question is, why is external liquidity so important? Because this is where huge liquidity pools exist. For example, suppose market is moving bullishly. Above the current market, there is a major swing high. That major swing high becomes external buy side liquidity. Why? Because many traders place breakout buy orders above that high or stop losses of sellers who think like that acts like a resistance, so we can sell from this zone. So above that major high, a huge amount of liquidity is resting, and smart money usually wants to attack those liquidity pools. Now understand this important concept carefully. Market often moves from internal liquidity to external liquidity. This means market may first manipulate inside the range and collect smaller liquidity and then expand towards bigger external liquidity targets. Now let's understand this with simple chart example. Now here you see this is market bullish structure in 50 minutes time frame. Okay, so what happened while going upside? Market suddenly drops slightly and it sweeps these small lows and collects this internal structure liquidity. Okay, this while it making this pullback, here some liquidity creates and that is called internal liquidity. So market drops and collects this internal liquidity and then it moves upside just like this. Then price will jump aggressively. So then what happens here? Most beginners panic and they think market reversal started, but actually market was only taking internal sell side liquidity. After collecting liquidity, market starts moving upward again. And where does it move? Definitely it will move toward major swing high. That major swing high becomes external buy side liquidity. So here, after collecting the sell side liquidity, where does market will go? Definitely it will go that higher time frame swing high. Here you see this is swing high, recent swing high. So market should go to this swing high in higher time frame in 50 minutes. But while reaching out this swing high, what happened here? Market just made some fake moves. Sorry. Market target is here. So while going from here, market made some internal liquidity and collected, again went upside and again liquidity and again went. So first it creates that internal structure and collects that sell side liquidity in that structure and it will move to its higher time frame swing high. This is actual target. So that major swing high becomes external buy side liquidity. So this is why professional traders always ask, where is the external liquidity? Because external liquidity often acts like magnet for the price. Now another important thing is internal liquidity is usually weaker and external liquidity is usually stronger. Why? Because more stop losses exist in external liquidity and also more breakout traders enter in external liquidity zones only. And also bigger liquidity pools are available there. Volume is high at higher time frame swing highs. That's why major reversals or strong reactions often happen near external liquidity zones. See here, you see market just collected this swing high in higher time frame, means external liquidity just collected, and then you see the move, how it happened, just big move, keep falling. External liquidity often acts like magnet for the price. Now remember, very important rule. Just because market reaches external liquidity does not mean immediate reversal will happen. Sometimes market takes external liquidity first and then continues trend also, and sometimes liquidity takes then reverses strongly, just like this. You see, it take that liquidity and then just reverse it in very strong way. That's why confirmation is always important in SMC trading. Never trade blindly only because liquidity was taken. Always combine market structure, boss, chalk, liquidity, order blocks, FEG, and confirmation. Now, quickly revise today's concepts. Internal liquidity means small liquidity inside current structure, and external liquidity means major liquidity outside the structure. Market often sweeps internal liquidity first, then price targets external liquidity. External liquidity contains bigger order pools, okay, and external liquidity often acts like a magnet for the price. Whatever I explained in this video, you also make sure that you will find out internal liquidity and external liquidity, major swing highs, and where is a huge liquidity, huge volume is present. Try to practice it in the chart. The more you practice, the more perfect you become. In my next video, I will teach you about what is FEG, what is order block, how to find trades using them. This thing I will explain in my next video. Till then, stay connected with my channel and subscribe it, like all my videos, share with your friends. Thanks for watching. See you all in my next video. Thank you so much.